Good afternoon, participants, and welcome to our monthly webinar. So let's kickstart the performance across schemes. So if you look at coffee can, if you look at the December return, we did a return of close to minus 0.7, but as compared to the benchmark, there has been a decent alpha generation. In fact, for the 6 months, if we look at the performance, we are up at about 4.1, whereas Nifty is in a negative zone. In terms of the top performers, KFIN, Abbott, and Trent have been the top performers. Trent has been a recent addition in the portfolio. KFIN obviously has been a star performer for the fund, up almost 186% in the calendar year. In terms of the draggers, HDFC, Pidilite, and TCS were the draggers as far as the December month is concerned. Moving on to Good and Clean Mid Cap. So Good and Clean Mid Cap actually for the month has generated a positive return. So the return was close to about 0.4 versus a negative return for the benchmark. 6 months perspective, the returns have been fairly good at 4% versus a negative return for the benchmark. In terms of the key contributors, International Gemological Institute, which has been a recent addition, that company recently came up with an IPO, and they are into certification of lab-grown diamonds. So that's been a recent addition, and that's done fairly well for the portfolio. Other than that, Blue Star and Lupin have also generated decent returns. And if you look at Blue Star, it's been a stellar performer as far as the entire year is concerned, with a return of almost 126%. The draggers take PI and Deepak Nitrite, but if you look at Aegis, it seems more like a profit booking. Stock is up almost 70% in the calendar year. Coming to emerging giants, so emerging giants, it was a tough month with returns of minus 2% versus a benchmark of minus 1.5. But if you look at from a 6-month perspective, the returns were fairly okay at about 5.1 versus a negative return benchmark. So basically, on a 6-month basis, the portfolio seems to be coming back. And this is more in perspective, wherein the momentum seems to have shifted more towards quality versus others pre-election. From the top performers, we also bought International Gemological Institute and Emerging Giants. So that's done well for us. And other than that, Arvind and Neogen Chemicals have also done fairly well. Amongst the draggers were Tips Industries, Alkyl, and Prudent. It seems more like a profit booking, given that returns have been fairly strong. Coming to 10x. So if you look at the performance, so it's been a tough month for 10x as well, with minus 2.8% return versus a benchmark of about minus 1.5. But again, if you look at from a 6-month perspective, it's been a positive return versus a negative return for the benchmark. Again, the top performer is International Gemological Institute. So we've been very bullish on this name, given that we are a firm believer in the rising penetration of lab-grown diamonds. And we believe that there's a significant scope for rise in penetration of people who will require certifications for this. And this is the only listed company which one can play in this segment. So that's the reason why we bought this across portfolios, given that it's an extremely high conviction idea for us. Alongside that, Lupin and Persistent have been the main performers for the month of December. Amongst the draggers, it's been Go Fashion, Prudent, and Aegis Logistic. Coming to Micro Marvels. So Micro Marvels has given a positive return of about 1.5% in the month of December. And as compared to benchmark, which has been negative. And if we don't have a 6-month history, but we have a since inception history. So it's got incepted on 29th of July. So if we look at from that perspective, then it's a minus 0.4% versus a minus 4.4 for the benchmark. So in a tough time, it has sort of been resilient despite being the riskiest asset class as perceived by many investors. The top performers have been Bajaj Healthcare, have been good contributors to the performance, up almost 50% and 66% respectively. Amongst the draggers, sides and Tejo, as far as the draggers is concerned. So I'll invite Trilok will take you through the newsletter we've written and also the macro piece. Over to you, Trilok.
Thanks, Bhargav, for sharing the update on the product performance. Moving on to the newsletter of the month and the topic that we've written on. So, I think so. We are very much aware on the kind of implications that the digital India on our lives have had in the last few years. In fact, every time we do a transaction these days, it doesn't matter the quantum of the transaction. I'm reasonably certain, at least in the top tier cities and the metros, and in the top, even the tier 2, tier 3, tier 4 cities, incremental adoption has taken significant pace. Through this newsletter, we have tried to put a different perspective on how that is impacting the consumer behavior, the businesses, how the businesses are prepared for the disruption, and what are the implications for the market, the stock market that's going to be. Moving, into this particular, the broader framework, as you can see in India is, amongst the very few market in the globe who have the technology layer, have identity layer, have, managed to, move from discovery to transaction, and most importantly, in a very secure environment. If I think India is the only potential market globally who still follows an OTP methodology to make a payment, either it's debit or credit for a sizable amount. Globally, if you look at any markets, most markets are obviously not attuned to that, and neither they are prepared for this. Thanks to a great job done by the central bank of the country and the regulators imposing this. The kind of the kind of growth that we have seen in terms of either social adoption or in terms of the activity in terms of digital SIP flows, or you talk about the UPI transaction, India stands tall, clearly number one or number two in across the world. I think the enabler of this has been a complete integration of financial services and products along with the banking system with the technology that is being utilized by the consumer. And B, the key stack, which is UPI, FASTags, DigiLockers, ONDC are some account aggregators, are some of the use cases that has developed to this in the digital economy over the last many years. To give you a perspective, in the last 5 years, India has grown 10 times in digital economy. Over the next 5 years, by 2030, the expectation is India will grow again, between 2.5 to 3 times. So, not only the growth is obviously going exponentially, but it is also changing at a rapid pace for all the businesses and the consumers to be prepared for this or get disrupted. It's a choice in the hands of the consumers and the businesses, that are they riding this wave, or are they trying to obviously just postpone the challenges that they will face in this digital transformation that is coming our way. When we move to next, which we talk about, what are the important few segmentations that have done well in terms of the overall transactions value, and what are the growth rates that it presents, and also what are some of the business models that has been presented in the market. So fintech, I think so, is quite prevalent across the world, and needs no introduction. I think so fintech is quite well understood, whether it's form of digital payment, or in terms of peer lendings, or in terms of investment platforms, or for that matter, even the new age economy stocks, that we that or the, I would say, neo banks, and the banks that they're completely different license that the RBI has given. Across these particular models that we have seen, not only they managed to survive the liquidity constraint that we saw in 2022 2023 in terms of cost of capital, particularly from the private equity and the venture capital squeeze, but also able to transform their business model from a meaningfully higher customer acquisition cost to to driving operating leverage in the business. So fintech has obviously come a long way from trying to sell the concept to now validating in terms of what kind of business models that are profitable as speak. I think e-commerce and e-grocery, I would combine it together. E-commerce is a much wider platform that we all understand, marketplace, account, aggregators, as well as, I would put it this way, businesses that are just trying to deliver at convenience, and the kind of ease that they obviously provide to the consumers has taken the whole market in completely by a storm. If you go back to, let's say, a couple of in fact, almost a decade ago, the whole debate by the country was how big the modern trade can become in the next decade or so. Now the whole debate is moved from how quickly the e-commerce can actually fulfill the demand of consumer, rather than modern trade becoming larger. And more than e-commerce, I think the quick commerce has become a center stage nowadays, as most of the top tier 10 or the top 10 city consumers want to sort of fulfill their demand in the next 5 to 10 minutes, rather than waiting for a few hours as well. So I think so the applications like fintech, online travel, grocery, food delivery, and e-healthcare are the largest applications as we speak in the country, from a total opportunity size, and the growth rate in these will be in excess of 30 to 40% in most use cases. The bigger only question that one should obviously completely keep in mind is, A, these acquisitions are coming at a much higher cost for the customers, and B, which of these businesses can can gain scale without obviously significantly expanding the balance sheet. These will eventually, being the in an aerodynamic changing model, these will be the businesses that will not only generate a strong wealth creation for the investors, but also create a segment in itself. Think about it. In travel, I'm sure most of us would not have imagined that we will not be utilizing Ola, Uber to commute from one place to another 5 or 7 years ago. But now, being this is a true sort of way of life. In fact, integration of global sort of maps and putting them on a single mobile phones, or handheld devices, has changed the way we commute, bringing disproportionate orientation to the economy. So in India itself, I think so, there's a study which speaks about the incremental economic value addition by only travel aggregators have been in the range of 12 to 14 billion dollars over the last 5 years in itself. So this is the model that are ever changing, but these are the broader pieces that has not only proven its success, but also demonstrated enough and strong potential in the next few years to come by. Moving ahead, if you look at how the markets have started to perceive, so as I said in the beginning, initially a lot of these business models were evolving. So the whole focus was to bring on as many customers on the platform, or on the app, or on the website that you are offering a service towards. But as the capital matures, and as the investor community mindset improves, the whole question moves from how fast can you grow to how profitable can you grow. Because Gaining at the cost of balance sheet is a very easy exercise that most businesses can do. However, gaining at the cost of operating leverage or better balance sheets is the most important element that one should focus on. So, in this parlance, I think so over the last 2 years, the new age economic stocks have done reasonably well in terms of ability to garner a lot of capital from the market. And this particular year, obviously, the biggest obviously bet has been biggest IPO has been Swiggy with $100 billion, 100 billion INR, sorry, in terms of capital raise. I think so as we progress on this particular platform going forward, you will see more and more such models gaining incremental share from the capital markets, and also businesses, particularly those who can generate profitability, or at least can prove that the model of unit economics to the consumers will be the one that will be lapped down by the markets going forward. With that, I will probably move to what are the few business implications that we think is going to clearly see some change. So I think businesses needs to be prepared. Either they be ready to build their own use cases in terms of technology, or they have, if they have reasonable strong balance sheet, they can end up purchasing the use case from the competitor to make it a collaborator and start being as a player in that market, or they can they can continue to deliver the same old way and they can perish. So in this, each of these sort of perspective, we have showcase how in a buy scenario where Titan has. So Titan, as we all know, has been the largest trusted jeweler in the country, particularly gaining a significant organized market share in the last many years. Not only have they delivered and created many forces in the country, whether it's talking about individual brands like Zoya coming out of the company, or you talk about the number of stores they have put across the country. But their obviously core essence was being a touch and feel model. uh, and in order to sort of expand their infinite potential in the country, they obviously missed the whole online potential of the jewelry market. So obviously that made them realize quite faster than most people have thought. So, and they end up taking a significant share in Carrot Lane, and gradually they become the majority owner of the company in last few years. So not only have they cracked the ability to sell online and offline, so they have managed to even make it a complete avoid any disruption that can hit them in the next few years to come by. As we can clearly see, despite on lower base, Carrot Lane has managed to deliver a 50% earnings revenue CAGR versus the 20% CAGR by Tanishq. Although its a base is very 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 high for them to drive that number, but trying to adapt to the existing changes and trying to purchase, if you're not capable of building it in itself, is a clear sign of leaders trying to think ahead of time, and Titan has demonstrated that capability time and again, whether it's the Carrot Lane acquisition, or even in the past trying to deliver many firsts in the industry, particularly with respect to the trust that it builds on the brand. Similarly, other case that you think about or that we're discussing here is PB Fintech. PB Fintech as a brand, as a business, as a model was completely built digital. Although obviously they have significant uh, employees who basically service their customers from on feet on street. But they were the first, the pioneer in the country to not only significantly sell the business online, but over the 90% of the business completely were built in such a way that people can easily access to the products. If you look at the NPP growth for that business has been consistently in the range of 25%, 30% plus, in an industry where the industry man was struggling to grow even in double digits in the last 5 years. Notably, in the insurance sector, we have seen many regulatory changes which not only impacted the segment, but also because the fintech, PB fintech, ability to offer their customers completely digital, sort of experience right from inquiry, or I would say discovery to transaction, which is buying an insurance plan, and their ability to offer a seamless and transparent pricing across the businesses have been a big sort of been a big advantage for them versus anybody else. And third and most important, I think so, is again a testament to the fact that some historical incumbents have not been able to adapt to the changes bringing on the segment, and Dabur is one such case which has not been able to deliver true to the expectations despite being a fantastic 100-year-old brand in the country. I'm sure every nooks and corner of the country is very familiar with the kind of brand equity that it carries, but their ability to adapt to the ever changing dynamic changes in the overall distribution and the way people consume the product has been a clear sort of, I would say, misreading by the company. In fact, in the same time, if you look at the ITC consumer business, has delivered an exponential growth, particularly post COVID, because the more they adapted on online as well as the ITC e-store, which contributes to more than mid single digit for the business for them. More importantly, their ability to even generate operating leverage, because they have done investments over the past many years, have delivered exponential 50% growth over the last many years versus the similar profile for Dabur. So I think in this ever changing businesses model, and the way capital is being chased by these innovative business model, the very companies should be very peculiar about the kind of disruption they can bring on board. It can either sort of build a great business, or they can actually sort of destroy the legacy that they have built over many years. So in that context, we wanted to share each of these cases with you. And that's how we think the challenges will continue to persist across businesses, and only companies who not only have uh, great market share, but also ability to protect market share by either driving pricing power, or trying to innovate in how do they distribute their product, or how do they participate in the distribution channel, will remain the key and most important matrices to monitor as we speak in the next era of digital transformation in the country. With that, I would sort of move to next, and the most one of the most important aspect in implication on consumers. I'm sure most of us have graduated to a completely new way of consumption, or at least moved on from a traditional way of consumer. As they say, right, Generation Y, pre-millennial, and Generation Gen Z, and the millennials. Particularly, I've been told the new kids who have sort of taken who have in the between 2000 to 2015 are Generation Alpha, which can obviously have even further demands on how they consume, how they have an opinion, and how they perceive on a particular brand perception. I think a clear transformation we have seen, whether it in all aspects of life, whether it's consumables or a discretionary, or for that matter even a mass affluent brands that we see. And clearly the kind of names that you see on screen have demonstrated exponential growth, who have either been able to correlate with the generation Gen Z, or Generation Y, or Generation Z, or Generation Alpha. And also the way these new consumer behavior changes on what kind of spending patterns they have on a particular brand or services. I'm very certain that majority of us would obviously be even debating on the subject of how many people will be happy to pay a delivery fee couple of years or 3 years ago. But post COVID, I think so whether it's food or grocery or even apparels, or even for that matter, as basic as probably day-to-day items, people are more than happy. Have fairly adjusted to the new norm of paying a delivery fee for the convenience and the kind of adaptation this particular segmentation has had. So, to my mind, innovation, convenience, as well as consumer preferences will continue to change the way businesses get built, the way market shares are gained, and the way consumers tend to sort of drift towards completely new age companies. So with that, I will obviously give a comment on my overall perspective on the newsletter, and I'll move on to the macro updates. So I think so. One thing is very clear: the global growths are certainly going to recede next in calendar 25. One of the most important element for them is the US. US growth rates is obviously projected themselves to come down and they also want to curtail the overall economy, interest rates, as well as what kind of inflation they are hitting it. So I think next US being will be the key driver of the moderation in growth rates globally. India will also grow, marginally lower than the last year. Obviously, the function of many factors. One being the capex being a little low by the central government, and I will talk about it in the subsequent slide. But Euro and Japan obviously will showcase a sharp improvement on a YY basis. Euro being obviously coming off from the troughs of CY 24, but Japan also as the economy broadly improving, and that's also a replica of a lot of factors that we see in economic indicators for the market. Moving ahead to the next, from global growth to what kind of growth happening in the India in the country. So I'm sure everybody has been talking about this particular aspect and recently getting worried on the economic growth. I think so. The biggest reason for the second half earning CY 24 economic slowdown and the earning growth was due to fiscal and monetary tightening that was demonstrated by the government of India. Not only the capex that was budgeted was significantly underspent, but also a lot of programs that was announced were actually postponed by the government of India. So I think public capex in India, unfortunately, the private capex is yet to pick up. In the absence of private capex doing very well, even moderation in public capex had a reasonable multiplier effect on the economy. I think the consumption was anyways growing at a mid single digit, and with moderation in the public capex obviously had added the whole challenges for the growth. We think given the very comfortable fiscal position and the next year we believe that capex will obviously come back, given the fact that government finances are not so tight. I think growth should rebound beginning post the budget, or as you can say in the first half of the calendar year and subsequently year as well, because there is a lot of infrastructure development that we are seeing already happening across the country, and the number of projects that were announced but obviously will start getting implemented as we proceed forward. So we are not very worried on the kind of growth rate receding. In fact, to our belief, growth rates could start picking up as we move forward. A, led by consumption in recovery happening across the rural markets and as well as certain pockets of urban. B, also with respect to public capex coming back. So first 9 months public capex has declined by 12%, and we are very certain it will be growing in the mid single digit to high single digit next year. And C, also a lot of factors, and the manufacturing I would say intervention done by the government of India will also start reflecting the export data as we move forward. With that, moving ahead, I would like to just talk about a little factor on demand supply, because that's also one of the concerns that most people are worried on. So I think the market multiples or expansions, multiple expansion will probably not happen to the extent that most people are perceiving, because going there's a lot of supply happening from paper in the market, and maybe FY 25 is the first year where the equity supply could exceed demand, if depending on the number of IPOs and the transaction that has been already lined up for the next 3 months. But more importantly, I would say the whole narrative driven markets, or the narrative driven stories that was being prevalent until CY 24 first half, has taken a backseat, and the number driven market or the number driven businesses will continue to do excellent job as we proceed forward. So in that overall perspective or journey, where the multiples were actually only getting re-rated despite not being a great number delivered by a company or a broader perspective, I think you will start to see a significant meaningful stock picker market, and we think very clearly that next year you will see only bottom of stocks, and the companies who can deliver disproportionate growth and market share will be the ones that will take center stage. Earning growth in the Q3, as we entered already the season, couple of names have already announced the results. I think the earning growth will move up on a sequential basis from a very very low 3% will move to 6% for the nifty companies. But nothing that the main driver of festive season being absent has been the biggest disappointment in the quarter gone by. I think the telecom, insurance, and retail will be the top performers in the earning growth for the quarter that is going to end. That's already ended and going to get delivered. And metals and consumers could actually see a low double digit decline in this particular year on a YY impact. Importantly, and I would say one of the last sector being banking. Banking will probably deliver I would say in line or marginally higher than the broader indices in terms of growth rates, thanks to the credit growth weakening in the market, and that also by a significant series of intervention done by RBI. Moving ahead from earnings growth to what valuations are we trading at? Market multiples continue to remain at long-term averages, particularly Nifty. Although in signs of pockets, there are multiples getting extended from a 3-5 year perspective. But as I said in the beginning, in my previous slide as well, when in businesses or the companies who will demonstrate disproportionate earning growth, or at least stable earning growth, if not disproportionate in the next 12 months or so, will be the key differentiator factor in how and why the market rewards them. I think so. Multiples only price to book wise, if you look at market, obviously trades at a premium, 10% premium to long term averages, but that's a function of the clearly reflection of meaningful better ROEs that we have seen in the market. And FY25 will be no different, where the ROEs will further expand compared to FY24.